I don't think everyone in the audience completely knows what private equity is, or they kind of know what it is, so maybe you could start by giving like a primer on private equity and then more about how you got into it and why you chose to go into it.
Should we start outline?
Yes, sure.
Actually, one question I'd like to ask, just to know who the audience is. How many are, can you tell us, sophomores, juniors, seniors, what's the, how many are seniors?
Seniors? Juniors? And the rest are sophomores and freshmen, I assume.
So what about private equity? Okay, so the way I think about private equity, it's basically investing in businesses and trying to make them better and hopefully make a profit on your investment. That is the idea. And the way I think about private equity is that you can think about real estate investments, right? When you are buying a home, so what do you do when you buy a home? You do a down payment, you get some mortgage from the bank, and then you own the home. And hopefully in 5 years, 6 years time, the value of the home would increase. You'll pay back your mortgage, you'll sell the home, you'll pay back the mortgage, and whatever remains is your profit. It's exactly the same idea, but you do that with the businesses. You buy the business, which makes some down payment, which is your investment, get some mortgage, which is the leverage, and hopefully grow the business and make it more valuable in 5 years time, and sell the business, pay off your leverage, and get the money as your profit. That's the idea of private equity. And we can probably, yeah?
Answering the same thing, or?
Well,
I can add to it. I mean, if you guys have questions, feel free to lob them in real time.
yeah, I mean, just like toss questions in. This is just the start of the question.
I think we could be a little at it.
Yeah, we can
a little at it.
Okay.
Yeah, so I think we'll just touch on kind of, I guess, the routes you can go. So there are a lot of, in terms of the private equity spectrum, there are firms that have a lot of hands-on knowledge. They work with managements. You're actually not only buying these companies and holding them, but you're going to board meetings, you're inserting new CEOs, you're working with them on strategy, whether it's M&A, new product lines. So you can be on that end of the spectrum. You can be, a lot of firms just do a lot of just straight investments. So it's more about deal making, finding the right investments as opposed to actually getting in and being in their hands, day in and day out. So that's something, I know it's down the road. If you're looking to go to the industry, you got to figure out what's best for you. I personally wanted to go to a fund that was a mix of both. And so at Apex, we had some interactions with management on a day-to-day basis. It was more high-level strategic thinking. We weren't in there directing the sales force, but also we weren't just completely, not present in the day-to-day decision making. So that's something to think about when you look at the industry.
I would also add, just as a career choice, private equity, generally people go into banking or consulting, usually banking, and then go into it because they want a job where they were acquired. They're usually very small firms with very few people working there. Even some of the largest firms in the world will only have, maybe a couple dozen actual investment professionals, people who are working on doing deals. So it's probably much more responsibility. Probably have to be a little bit more thoughtful. The trade-off being you probably don't get as many deals done, and you spend a lot more time in this particular business. And some people find it to be, a lot of people look at it as a very natural step that you go into your banking job and then you go into private equity, you're going consulting in private equity, but private equity is a huge spectrum, and it's also kind of, while it seems like a natural step, it's also a bit of a step change, career change. So as you're thinking about it in the future, be very cognizant of the firm you're going to because they're all very small and they're all very different.
I can kind of touch on like the difference between a hedge fund and private equity at a very high level. With the house example, the other thing that is implicit is it's not a liquid investment. So meaning if you buy a business, you're going to hold on to it for a few years. That's the difference really between a very high level between private equity and a hedge fund. In a typical hedge fund, you buy a position and you assume you can get out of it if you decide you made a mistake or the investment goes the wrong way. If you buy a business in private equity, it's very hard to get out of it. You typically have to kind of hunker down and work with the business to make it better. I remember at Avista, we bought this company called Star Tribune. They're a newspaper in Minneapolis, and they were having a hard time like 2 years ago, and we thought we could turn it around, and it actually just ended up keep getting worse and ended up burning money instead of making money, so we had to try to fix this company, and ultimately ended up going bankrupt. If this was an investment in a hedge fund, if they bought like McClatchy, which is a large public newspaper, and started going down, you could just dump your investment, as long as your position not too big. But that's generally kind of the difference between the two types of.
So you mentioned that after a certain period, you sell your investment or you sell the business. How do you identify buyers, and what is the market for buyers like? Do they come to you? Do you go to them? Are there a lot of potential buyers out there, or how do you make that decision about when to sell and who do you sell to?
Should I take that?
Sure.
Yeah. So there are two kinds of buyers that you go after. One set of buyers are called financial buyers, and the other set of buyers are called strategic buyers. And the third set is going to the public market, okay, doing an IPO. So financial buyers are like private equity firms. We are on the $500 million size. We might take our asset, our investment, and sell it to another private equity firm, or sell it to a bigger private equity firm who wants to enter that industry, enter that segment. So that's the financial side. Strategic side would be that if we are operating in one segment, and we can approach a bigger player in that segment, or who's operating already there, or we can approach one of our competitors, and we can try to sell the company to the strategic player, where they can get the value out from because of the long-term strategy for the fund. And the final, as I said, was you can actually take the company and IPO it and sell it in the public markets that way. Right?
Well, it's also private equity firms. I think any investment, any type of investing you go to is very much dictated by the terms of how long people commit their money. So people generally commit their money to private equity firms for 5 to 10 years and expect you to double to triple their money or better. So on most investments, you try and at least double or triple your money. So you kind of own it as long as you have to do that. And that'll depend on a lot. Would you guys agree with that?
Yeah, I mean, in terms of timing, it varies, right? Obviously, you don't want to sell the business until you're pretty sure you're going to make money on it. Having said that, there's all kinds of, whether it's the way your fund is structured, there's other constraints you can bump up to, but that's kind of a rare instance. Which option you choose, you obviously want to maximize the value you get for the business. So sometimes the public markets are just high, and you think that we're going to get a fair valuation or higher than expected valuation going that route versus strategic buyer. I mean, maybe there aren't that many strategic buyers, and the ones who are out there are cash strapped. So you really have to kind of think about it strategically in terms of where you're going to get the most value for that asset. And in terms of actually going through a sale process, if it's a large company, you can always just hire an investment bank to basically run that entire process. So you're going to want to go out to a bunch of firms who you think have an interest, make a competitive auction, drive the asset price up as high as you can, select one of those guys and sell it. And usually the bank will just run with it. Or, I mean, there's varying levels of responsibility you want to give them. You're a small team and you're tied up on other things, and you can kind of let them just run with it, and you oversee the process and make sure that you're representing the asset that is in a light that you're comfortable with.
So let me just take back to the home analogy. So when you're trying to sell a home, what do? So you get a broker, and you let the broker list the home in the database, and the broker would get the buyers. It's the exact same concept. You get an investment banker who will study the company, who will prepare a memorandum and talk about the strengths and the opportunities of the company, and take that memorandum and show it to different buyers and get interest, like how are you interested, are you not interested, what is the kind of price you're going to pay, and that is the competitive auction that he referred to.
And typically during that process, those buyers will come in and start to due diligence on the company that you own. And there's multiple steps along the way where you ask for preliminary bids, cut people who don't look like they're interested out of the process, and keep it going until you have a few, hopefully, players who are really interested, and they'll fight it out and they're pricing for it.
That'll vary too. Sometimes it's just get an inbound offer that's great.
Yeah.
Run a really quick process and just take it. It's usually very.
How different are private equity firms from VCs in the entrepreneurship scene?
Yeah, I think there is a point where maybe it's blurred on the much smaller end than kind of the lower market in PE, but it's a very different approach. So most of the time VCs are there, they're putting capital into businesses that either haven't generated revenue yet or are unprofitable, and it's really kind of a growth mechanism. So maybe they're in it for a little bit longer. It's much riskier, but they expect a much higher return. So you're more betting on the ability of like managers and business models to succeed into the future. Whereas PE, a lot of times, and I think where all we worked, we're betting on established